So I've been investing for about 9 years now, and in this video, I'm going to break down my entire investment journey, show you my exact portfolio as to what I'm currently invested in, and tell you how much I've actually gained from the stock market, both financially and mentally, through the life and investing lessons that I've gotten so far. And hopefully, we can learn a thing or two from each other as you share your thoughts in the comment section down below as well. So before we start, as always, full disclaimer, I'm not in any capacity to provide any form of financial advice. And what I'm sharing in today's video is specific only to my own circumstances. And please do not apply whatever I'm saying blindly. And to protect myself, I can only assert that you'll definitely lose money if you follow me. So please do your own due diligence. And with that out of the way, I'm just going to show you right off the bat my entire portfolio value and my initial capital contributions. So like some of you with multiple broker accounts, I actually use this portfolio consolidation platform called Portsedo, and it helps me with consolidating all my trades and track my investing performance against the different benchmarks. So as of the time of this recording, my portfolio value sits at roughly $291,000, and the initial capital I injected is roughly $198,000. And if I was investing in the S&P 500 instead, it would be $279,000. So yes, I'm technically better off doing investing on my own for now. So based on the track record of the past 5 years-ish, and since we have a rather global audience here, even though I'm based in Singapore, I'll base off the entire discussion of this video via the US dollar denomination for a common form of reference. Now, I know you probably have a lot of questions about what happened to the 9 years in the title. How do I know I'm beating the market? Where's the proof? If not, I'm basically just pulling numbers out of my ass, so on and so forth. So don't worry, I'll try my best to share everything as transparently as possible in this video. And I only hope that you can help gently tap that like button underneath this video in return. So let's start off with the why. Why this topic? Why this video? So I believe this exact format of sharing is pretty huge on the YouTube personal finance space. But most examples are pretty Western centric. And the ironic thing is that in Asia, I believe that we are pretty money-minded, but we don't always talk about these things openly. And I hope to push the conversation forward on this side of the globe. And here's my story. So the title says 9 years ago because my investment journey really started in 2016 when I just turned 18. Now, I didn't do the usual open a brokerage at 18 and YOLO into my first stock. My story was much more Asian. So I grew up with a dad who's a pretty bold stock investor. And around the 2015 to 2016 era, he kept drilling this idea into me: passive income. So you should own real businesses, let them operate, and just wait for the few $100s hit your account every quarter or half a year, and just sit back and relax. So sounds like a pretty good proposition to me, at least. And in Asian culture, especially during Chinese New Year, we get red packets from relatives. And over the first 18 years of my life, coupled with my own savings, I've probably accumulated somewhere north of $5,000 to $10,000. Not a lot of money, but I think still sizable enough at that time. So in 2016, my dad just asked me, "Hey, you got cash in the bank. What are you going to do about it?" So the long story short was that he was eyeing a few stocks listed in the Singapore Exchange, and he casually told me that he's buying X amount of lots in this company called Keppel Corporation. So don't ask me what it did. Clearly, I didn't have a clue. I just know that it was an oil and gas company, and I didn't do much analysis at all back then. So he said he's buying some, and if I'm interested, I can transfer him the money for my part, and it will help me buy and hold the shares, plus help me cover the transaction fees involved. And here's the kicker that pushed me over the line. He promised to cover any form of capital losses, and I'd be able to keep the dividends. So to the 18-year-old me back then, that sounded risk-free, and the rest was history. And on this topic about paying commissions to your brokers, I do have to give a quick shout out to Longbridge Singapore that's sponsoring this video. So for my Singapore viewers, you're in for a treat. What if I told you you could get free Nvidia shares just for getting started with investing on Longbridge? So Longbridge, a MAS licensed broker in Singapore, has a promotion running right now. And if you sign up with my link and deposit just 2,000 Singapore dollars, here's what you get: a 6 plus 6% per annum interest boost on your first $2,000 for 90 days, exclusively through my link. And that's $60 in interest if you park the cash in their Cash Plus product. On top of that, you get an additional $18 cash coupon just for signing up and depositing. And if you hold your funds for 30 days and complete 3 buy trades, you'll receive half an Nvidia share worth about roughly 100 Singapore dollars today. And add that up, and you're looking at around $178 in value on a $2,000 deposit. And that's 8.9% before you even start investing. So you also enjoy lifetime commission-free trading for US, Hong Kong, and Singapore stocks. 0 platform fees, and if you've got more capital, rewards can go up to $800 in total just for getting started. So don't miss this out. Click on the link in the description below to grab your exclusive rewards. And thanks to Longbridge for sponsoring this video. So Keppel was trading roughly $5 to $6 per share back then, and a lot was roughly 1,000 shares. So that one purchase alone basically wiped out most of my entire net worth back when I was 18. But a few months later, my dad would forward me a few $100s in dividends every now and then. And that was my first real taste of quote-unquote free money. So fast forward to 2017 to 2019, like every man in Singapore, I was called up to serve the nation via national service. And I had many pockets of time. So I went full nerd mode. Economics, markets, everything from value to growth to deep value to momentum, and even technical charts. I read basically every forms of books around investing. I didn't discriminate, but at the end of the day, the value-oriented mindset kind of stuck. Because I stayed in camp, meals and lodgings were covered. So I saved extremely aggressively. There were no big nights out, no girlfriend budget, and I even picked up extra duties as a side hustle from my fellow colleagues. And it's probably not exactly by the book, but hey, by the end of those 2 years, I'd actually built my first ever war chest. It was roughly 20,000 Singapore dollars. And again, I wiped out my entire net worth by buying 1,000 shares of DBS Bank back then, which was around $20 per share after I was done with army. So in retrospect, I believe it was these behaviors of constantly going all in into one stock that cultivated the bad habit of me not thinking about portfolio management and diversification in the grander scheme of things. Anyway, not to bore you with the details, I then went on to pursue my finance degree from 2019 to 2023, and in between the semesters and during the weekends, I took up part-time sales roles, give tuition, some writing side gigs, took on finance-related internships, and I started this YouTube channel in 2021. So really, there was nothing that was built overnight, just steady cash that I funneled into this portfolio. So fortunately or unfortunately, I don't have a dramatic hardship arc. Although I'm not like conventional rich, but I was definitely privileged. My parents taught me money basics early. They planned their own retirement so that I don't have to be too worried about it, and set aside for my school fees so I don't have to graduate with a 30,000 debt bomb on my shoulder. So that head start definitely mattered, and I want to be transparent about it. So the other half, I believe, is more about how I'm naturally wired. So I'm pretty minimalist, public transport, the same simple food on repeat, and I have zero interest in Labubus or the latest shiny toy. And most of my electronic gears are second-hand, bought on discounts or via credit card rewards. So those habits let me save aggressively for years, and that's the real engine behind what you're about to see. I've basically covered a large part of my life story, and now let's get onto the investing side of things that most of you are probably interested in. So to jog your memory a little, the initial screenshot I shared from Potsedo at the start is actually a measure of my performance since December of 2020. And yes, that is also when I started to take investing a lot more seriously. So it was also during that period of time where the low-cost brokers started attacking the Singapore market. And I kissed goodbye to the bloodsuckers, charging me minimally $25 per transaction. So on my 2 early Singapore picks, both Keppel and DBS Bank, I didn't hold them through. I exited them near the tail end of 2020 after the pandemic rebound. So I don't exactly remember the reason for selling them, but I believe I was raising cash for me to start managing my own money for real. On my exit price-wise, I was roughly flat on both, but you can add back the years of dividends that I accumulated and I'm probably net up. And yes, if I've actually held till today, the returns would likely be pretty respectable given the recent run-up. So that's a preview of a lesson you'll see again in this video of thinking long-term, I guess. But anyway, to walk you through the breakdown of my portfolio across the different platforms, we'll start from the smallest to the largest. So this first broker is kind of like a legacy account that has held some of my most initial buys of Alibaba. The position size is about 3.7 thousand US dollars and it's up $300. So I'll treat it as break even. And the second account is currently at 17,000 in market value and 7.8 thousand of that is in gains. So I'll leave it on the screen as to the breakdown of capital versus market gains so that you can follow along easily. So this third account sits at $93,000 in market value and roughly 20,000 of that is in gains. And the last account, unfortunately, is denominated in Sing dollar. And I have to do a brute force conversion for you. So 236,000 Sing in account value equates to roughly 183,000 US. So with 57,000 US in gains. So if you want the uncropped version, which includes my entire net worth, I've posted a members only deep dive recently and the join button is below. So there's a small paywall that helps support the channel and it allows me to share more candid details without the noise. So it's totally optional, but if that's your thing, I'll see you on the other side. So when you add the numbers up, I think it should generally tally with the ones reflected in the Potsato platform. And the discrepancies could be due to some extra cash being parked in the broker, which sometimes is being earmarked for some of my options trading portfolio. And also the past realized gains and losses, plus some dividends. So if you strip all of these out and just look at the portfolio performances on my long-only stocks, the transactions I track on the tracker are the most accurate and clean items. And this is as transparently as I can show you on my individual positions, the cost price, and the allocation. So specifically for this video, it's not so much about my investment philosophy or strategy breakdown. So I wouldn't be going into the weeds of talking about the individual stock thesis, but I did get AI to do some sort of a portfolio summary analysis. And this was what they had to say of my investment style. And you can pause the video to read it. And on a side note, some of you might wonder, why bother tracking our accounts so religiously? I think mainly for two reasons. First, personal momentum. So without a visual feedback loop, saving feels like shouting into the void. So seeing the curve rise slowly keeps me consistent. So this is much more a feel-good mechanism to keep myself persevering into this investing endeavor. Second, it's more about truth and accountability sake. So stock picking is definitely a bet that you can beat the index. So it measures contribution, dividends, and price gains, and of course the FX issues against a benchmark. So if the data says that I'm not adding value after fees and FX, I'll have to do a lot of reflection. And here comes the very interesting part. I've very publicly shared my entire portfolio building progress on this channel since early 2021. And I was ridiculed, laughed at, and destroyed for the past 3 to 4 years, as I was very vocal about my bullishness around Chinese stocks. So even until today, I think the Chinese basket on the aggregate makes up more than 60% of my portfolio. And I'm not shying away from that fact. So many of my previous positions were down 50% from cost, and especially in 2022, my portfolio looked disgusting, even after averaging down for close to 2 years. And given this recent rally, Potsato's performance chart shows that I've now caught up with the S&P 500 on a money-weighted basis over the last 4.5 years. So some nuance to note is that this isn't a lazy, oh, S&P did X% over 4.5 years, did I beat it comparison. So Potsato is pretty special, and what they do is to mirror my exact cash flow timing. Same deposit dates, same sizes. So in other words, it kind of asks you that if I put the same money in the index at the exact moments I actually invested in, what would be my IRR? And that's why the annualized returns on those synthetic S&P or QQQ tracks show a 16 to 21% return, a lot higher than the headline numbers. So it reflects that my biggest deployment tended to cluster during volatility and cheaper valuations. And the benchmark actually gets the benefit of that same timing too. And that makes it a much fairer apples to apples test of capital allocation skill. And this is, in my view, the most underrated feature of Potsato. So I'm not sponsored by them, but I do have an affiliate link. So if you would like to try out a 14-day free trial, you can click in the link down below. And you can just import your transactions via Excel in a couple of minutes, and it will give you a very crude and real reflection of your investing performance thus far. So to see what I mean, under the Trade Analysis tab, it overlays my buy and sell dots on the price chart. And you can literally see the density of my buys actually spike during the tariff headline volatility, which is exactly why the SPY and QQQ money-weighted returns come out a lot higher. And let's be real, I think in a bull market, a rising tide lifts all boats. So the US and several key markets are at or near their all-time highs, and even the laggards have rallied hard. So eking out a bit of outperformance right now isn't exactly the trophy. To me, what matters more is the consistency, showing up for 5 years, sticking to a process, riding the drawdowns without doing anything dumb. And that's the achievement that I care about. And I'll say this upfront, I think anything under 10 years can be a fluke. So come back in 2030 and judge me on a full cycle. So did I stay disciplined, keep compounding, and still play the same game? And that's the scorecard that I'm essentially optimizing for. And of course, hopefully, I'm still beating the market whilst holding on to and refining my investment framework. Now, building this video actually forced me to look back. And I'll be real, over the last 5 years, there were 1 or 2 moments I wanted to stop posting and just disappear. Not because I wanted to quit investing per se, but because the scrutiny started to get extremely heavy, especially if you're somebody that talks about individual stocks and they've constantly been going down and down and down. So in drawdowns, the market amplifies every negative emotions you already have. But creators actually feel that in public, multiplied by multiple folds. But there's a flip side that I wouldn't trade with. So I've met many like-minded strangers who became friends, and putting ideas out here means that the harshest critic helped expose my blind spots. So the intangibles, such as accountability, sharper thinking, community, are worth much more than the abuse that I get in the comments below. Honestly, I could be paid a lot more for doing something quieter, but I love this game. So you'll probably get bored of me before I get bored of stocks. Secondly, especially in this entire investing domain, I was actually asked multiple times, both online and offline, what keeps me optimistic enough to insert question here, to hold Alibaba, to look into the Chinese stock market, so on and so forth. So look at this returns graph. For roughly 90% of the last 5 years, I underperformed the index, no doubt about it. And yes, I kept adding to a few bleeding positions, and you could call that sunk cost fallacy or just pure stubbornness. And the flattering word to use here is that I have conviction, whatever that means. And the truth, I think it's a mix of research and a mix of faith. So investing sometimes do feel a lot like a religion. And you need faith in your strategy and faith in your thinking. Not blind belief, but a willingness to stick with a process across different cycles. So think about the 2008 financial crisis or the dot-com bust or even the recent pandemic. The investors who pressed their bets weren't fearless. They had a thesis, they had some faith that things would ultimately recover, they don't know when. And I'm not just talking about just stock picking. Even plain old index investing requires some form of belief that global businesses keep producing cash flows, that diversified ETFs will capture those cash flows over time, and capitalism doesn't collapse next Tuesday. So could it all go wrong? Definitely, but who knows, right? Thirdly, about this idea of opportunity cost. So I get oddly personal when people throw that term around in investing. So in economics, opportunity cost assumes that you know the payoffs and the difference in decisions. But in the markets, you don't. It's probabilities, distributions, and unknown pathways. So when someone says, you should have put it in X, you'd be better off, that's hindsight bias pretending to be logical. So if we had perfect foresight, we wouldn't be debating about different portfolio positions and investment theses. We would just buy the next winning lottery number and call it a day. So what actually matters? Did the thesis have positive expected value? Was the position sizing okay? Did we cap our downside so that we could survive long enough to be right? I think you can judge the decision by the information available back then, not by today's stock charts. And on an adjacent note, there is a lot of talks about, being early also means you're wrong. So I get why people say it, but it's also very hindsight coded. Early can be fine if the payoff is large enough to compensate for the time and pain. Simple math. Even if you look flat for 9 years and the position triples in year 10, your 10-year CAGR, compounded annual growth rate, is still 11.6%. And that beats a steady 8% compounding. So the key is staying solvent, sizing appropriately, and patient enough to let the distribution pay you. So don't get trapped by what I call screenshot thinking. And the only cost that really ruins you is the cost of being out of the game, especially after enduring all the pain. I'm not trying to make a poem here, but you get my point. Oh, and one last reflection on the point about diversification. So when you're young and naive with a small capital base, I think it's pretty meaningless. I'm not trying to give you any form of advice, but the goal is not necessarily about don't diversify, but more about accumulating capital in the shortest possible time so that you feel uncomfortable not diversifying. So I don't necessarily have a good opinion to share on this topic, but I do think that it's one of those lessons where you have to go through it yourself before you can really appreciate the takeaway. So if you've stayed with me until the end, I hope you enjoyed the discussion, and I'll see you in the next video, but more importantly, and hopefully, I'll see you guys on the moon. Goodbye!